Hi, Paul Gerard from Price Accounting Services, back with another video in our channel on investing. And this one is going to cover ETFs and shares and why they are very, very, very different, contrary to the views of many investors. This is a common issue we find at the year end when it comes to tax reporting, and it's just an element of very common confusion. And so we're going to give you all the details you need to understand the difference between different types of investments and how they might affect you for tax purposes, so that you provide us with the right information which keeps your costs down. Okay, so when we talk about shares, many people think of them as if you buy them on the ASX, therefore everything's a share, and that's far from the case. So what do we commonly see as traded on the ASX can include LICs, listed investment companies. Now that is a share, but it's a different type of share, and that'll come into play later. We'll explain some tax issues around LICs. Then there's company shares. So if we think of standard company shares, we're talking about the BHPs, the banks, etc. Okay, so shares can be both listed, i.e. ASX, NSX, Newcastle Stock Exchange. I don't know if Bendigo's still floating around, but yeah, we've got a few exchanges around the country. And also, in addition to listed shares, there's unlisted, so private companies, etc. Okay. Then there are ETFs, exchange traded funds. Now, exchange traded funds look and feel like a share, but they are not a share. They are a unit in a trust. Okay, and that has very, very, very broad tax implications and affects you in different ways to a share, very different ways. So we'll explain those. Then there are managed funds. So if we think of managed funds, they can be listed or unlisted, and they issue units to unit holders. So you acquire units and you can reinvest units and so forth. So the key difference here is companies generally tend to issue shares, and ETFs and funds issue units. Okay, and in each case, it gives you a fractional entitlement to the overall capital of the entity. Okay, so it's your ownership. You own a unit or a share, and it has a value which is either listed or unlisted. Okay, so let's now run through some of those differences that we've been talking about. So dividends and LICs, they're generally cash-based. Okay, so if you're made entitled and payment is made available or you're entitled to it, that's when you incur the income. Whether you actually receive it or not. So just because a check's lost in the mail, no one pays by check anymore, but you know what I mean, if you have bad bank details and haven't updated it and so it sits on the registry, it's still considered received because you are entitled to it. It was paid to you, it's just you didn't give them the ability to physically pay it. And that doesn't change the tax situation, okay? So now one key difference between a LIC and a standard share is many, but not all, LICs sometimes pass on tax deductions as well as the dividend portion. Okay, so keep your eye on your distribution or your dividend notices for that. This is something we sometimes will need to be sent a copy of. Okay, not the dividends. If you've got a summary somewhere, that'll be fine. We don't need all the dividend statements and notices because, for example, your CommSec AussieX report may well summarise that. Okay, so that's fine. So summary is fine because we can compare it to what the ATO has pre-filled. In some cases, the pre-filled data is very reliable. In other cases, it is far from reliable. So it's very important that we still check it against what you claim was received as income. Okay. ETFs, okay. There's a very common point of confusion with ETFs, which many brokers get wrong. They don't help because their information reports give you the wrong information. So in the accounting video prior to this video, we did touch on the issue, but I'm going to explain it again and in probably a little bit more detail, that ETFs, the pay income, will generally pay on an arrears basis. So for example, if you own your units on the 30th of June, you will receive a payment after the 30th of June as an entitlement. And this is where the tax difference is. Because of that entitlement, you are taxed on what's called a present entitlement basis. So for example, if we use the example of your VAS ETF, the Vanguard Australian Shares Fund, then the 4 distributions cover the quarters. So the September quarter is July, August, September, then the December quarter, March quarter, June quarter. But the payments specific for tax purposes will occur in the likes of October, January, April, and July, August. Okay, those 4 payments are what is represented in your annual tax statement that they also issue. Now, you'd be surprised how often we get told, "No, I didn't get a tax statement." You did. You need to provide it. Okay, and the likes of self-wealth investors here have a further problem, because self-wealth and other brokers you don't have a HIN. You get a fractional entitlement, and you don't actually have physical holdings, so you don't get a tax statement, and it's up to self-wealth to produce that. And yes, they do it. We get told many times, "I haven't got anything, I haven't got anything." You will need to contact self-wealth or log in and access that income information, okay, because they do have it there. Very important information in there. So this tax statement is very necessary to explain what the tax elements are of the income entitlement. Now, I'm now going to cut away to an image of a tax statement to assist you. We're going to walk through an example of an actual distribution statement for 2021 that has been shared with me. Okay. So on page 1 is a breakdown of common tax return labels and amounts. Now, this is typical of a tax statement for an ETF or fund. They all vary, okay, but they're very common in their elements. They do contain some flaws, and we're going to walk you through that. And then on page 2 is a more detailed breakdown. This is the bit I prefer to use and look at, because it's dangerous to look at, for example, on page 1 it says put this number in box 13U, for example. But that assumes it's your only investment. If you've got multiple investments, you might have to enter it in a different way. So that's where I prefer page 2. So if we look at the items on page 2, we can see there's an item 13 breakdown for the trust income of 129. There's some franked income. There's franking credits. So all of a sudden you're getting more than just cash here. You've got franking credits. So this all goes into play. Then at item 18, it talks about the type of gains you've got. And in this case, it's a discount gain. Now, a lot of people get this very confused. And they say, well, for example, my gain is $4,000. Well, it might not be. It's actually $8,113. The reason for that is if, let's say, you also have some CBA shares you sold for a loss and you lost $4,000, you must, in your CGT calculation, consider the $8,000 and deduct the $4,000 before a discount then applies. So the order and sequence and timing is very important. So we need that detail on what is a discount gain, what is a non-discount gain. And you'll see at item 18 there's another $10,000 of non-discount gain. So pretty important if you've got CGT losses, I would argue. Item 20 then starts the breakdown to show foreign income. So there's some foreign income, and there's also a foreign tax credit, which strangely in this occasion seems to be more than the amount of the income. But this is what happens. And then item 13 is easily missed. There's a further bit down the bottom, $10,202 of withholding tax. That commonly happens because the investor didn't quote their tax file number on time. And we often find that, at least for the first quarter, and then sometimes the quarters following, where the taxpayer hasn't provided their TFN. So then again, we need to know that so that you get the recovery of your $10,000, which will then credit against any tax liability and may see you with a refund. Okay, so pretty important. Okay. Now, there's also another element shown on that report. This is a really important element. There's $154, which is a CGT cost-based adjustment, the AMIT amounts, right? So these tax statements produce that information. That AMIT cost-based information would be used in the likes of ShareSite to reduce your cost base of what you originally bought your ETFs for. So in this case, your Regal fund the cost base for your holdings falls. And that has implications for a later capital gain. Okay, so it's not just ignored, it's not just tax-free, it's not tax-free. They used to call it tax-deferred amounts. They've gone away from using that word, but it is a tax-deferred amount because later on you will pay more tax on the potentially on the capital gain because your cost base is reduced by $154. So in theory, I guess if you compared before and after calculations, you now have a larger capital gain and potentially a little bit more tax. Okay. Now we're going to flick over to page 3 of the tax statement, and we can see that the total income is shown there. So this is where you might consider how much did I receive during the year if you wanted to check the amounts paid in, for example, each distribution payment, including the one paid after the 30th of June, which is shown on page 4. So that's the annual distribution amount. So that all got calculated and it was correct. So that, yeah, it's just guiding you to check and refer to your own information. So I hope that's been helpful in terms of providing you with some guidance on what these tax reports look like, and then I'll flick over to another CommSec Aussie X summary page, and this gives you the example of why you can't just pick the numbers out of Aussie X, because if we looked at Aussie X and we said what was the Regal income for the year, it says 1,023 is unfranked. No mention of franking credits, no mention of the withholding tax, no mention of anything else. So you see, the numbers aren't right. So this is why you can't rely for certain investments on your broker reports. So I hope that's been helpful. Managed funds and ETFs, though, are largely the same whether they're listed or unlisted, okay? We do see some variation in those various tax reports, but they're commonly the same. One word of warning, though. They commonly assume a taxpayer is entitled to a 50% CGT discount. So in that case for the Regal statement, if that had been an SMSF, we must adjust it because the self-managed super fund only gets a 1/3 CGT discount. Or if, as I gave the example a moment ago, if the investor has other gains and losses, it could be that the discount isn't available. So that's why we don't use the net discount when we're dealing with investments until the final CGT calculation. Okay. One further investment type I haven't mentioned is what's called a stapled security. Now, I don't know the brains trust who thought up stapled securities, but the bane of my existence, particularly when we use the example of the old Westfield. And Westfield went through reconstructions and demergers and mergers and reconstructions and split. And eventually they looked at winding the business up and selling it, and they reconstructed everything back to new units and old units. Oh, it was a nightmare. And you needed to be a scientist working with NASA to be able to work the thing out. So stapled securities are a wonderful product, and they comprise both a share and a unit in a trust. And sometimes more than one trust, as in the case of Westfield. And a stapled security, quite common but a bit complex. So they refer to it as stapled because the share and the unit are attached and can't be separately sold. So as an investor, you can't decide to sell off your share. And I'll use the example in the Sydney Airport Corporation was one. It's recently been acquired. So that entity is being delisted. And the unit holders, etc., were paid out. So what happens with the stapled securities? They can't be sold, they stay together. But from a tax perspective, think of it this way. You end up with the cash basis for the share element and the present entitlement basis with the trust element. Then you end up with a tax statement and a dividend statement, and it's all pretty messy. But fairly straightforward if you just provide the tax statement. So can always be dealt with. One further issue that can sometimes arise with distributions and dividends is dividend reinvestment plans, and we're going to now pop on a image of a platinum European fund just to indicate the nature of how sometimes these reinvestments can and will be treated. So on this platinum European fund, we can see that there's and in this case it's only an annual distribution, so the tax statement and the distribution notice are all one and the same, and we can see that the sum of the distribution is $3,831.64, and that further units have been allocated. So what does that mean? Well, from an accounting perspective, it doesn't mean you didn't receive any income, far from it. It means you both received income and were issued further units. The issue to note in this situation, though, is that whilst it says the reinvestment occurs at the 30th of June, it actually doesn't on this occasion. The income entitlement arises on the 30th of June and the new units are issued on the 1st of July. So think of it this way, in your records you need to keep a record of the income, 30th of June, and then make sure you keep a record of your cost base so that you're keeping track of the progressive units on hand for your fund, and it will then add a further 1,085.7 units. Some funds offer fractional units, and so it's fully invested on the 1st of July, so you'll just need to keep a record of that in your CGT records. However, sometimes with shares that's a little different and you can end up with cash residuals. So many dividend reinvestment plans for companies will make you entitled to the income, and yes, it is taxable, and then they will issue further shares, and they will also show on the base of the tax statement. For example, Westpac do it a bit where they're tracking the cash residual. It might be $2 and you're owed $2.07, and then you get your dividend credited full amount, and then provided full value can be given to a rounded number of shares, they then treat that as, for example, purchase another 32 shares, leaving another cash residual of $1.07, and that rolls on to the next statement. So it's very important to get that right. We sometimes see people who will treat the dividend amount or the reinvestment amount as the dividend amount. It's not quite the same. So watch that, particularly if your broker reports aren't very helpful. Just send us the information. If you have a look at no, we won't look at that. There's one rare exception to the dividend reinvestment plan, and I want to touch on it because it's rare, but sometimes it gets raised by people. A very small number of companies may allow investors the choice of not opting into a dividend reinvestment plan, but opting into a bonus share plan. Now, this does change the amount of income you receive in comparison. So be wary of that, but you don't pay tax on bonus shares. But bonus shares don't have a cost. So I want to explain the technical side of how that is dealt with. So when bonus shares are received, they won't be taxed as income, but when they're sold, they do have a cost base, yet they cost nothing. So let me explain how that works. So unlike the receipt of bonus shares generally retains the same dollar cost base that you previously had. So let's say you own 10,000 shares that you acquired for $1. So cost base is 10,000, and then you receive 100 bonus shares. So now you got 100 further shares. You take the dollar cost base and you divide the number of shares, so your cost per share has reduced. Think of it that way. So the effect of a bonus share defers CGT rather than producing taxable income. Does that make sense? I hope that helps. So that's the issue of bonus shares. So pretty rare, but if you do have bonus shares, don't panic thinking it's suddenly taxable or anything like that. That's how it's dealt with. So just make sure you keep a diligent CGT record of your bonus shares, diluting your cost base. Right, so I hope that helps. So until the next video in this channel, we hope you've enjoyed this and you found it informative, and we'll see you in another video. Cheers. Thanks.